Hi, my name is Angelica and my presentation today is regarding the piercing of the corporate veil. In today's presentation, we will be discussing a landmark case called DeWitt Truck Brokers Inc. versus W. Ray Flemming Fruit Company. I chose this case is because I know that for many business owners, it's difficult for them to understand that it's very important to keep their personal money and their business money completely separate. The significance of this case in the legal environment of business is that this case, DeWitt Brothers Inc. versus Ray Flemming Fruit Company, is an example of the court actually piercing the corporate veil. It's a highly referenced court case that serves as precedent for both consumers and businesses when they go to court as they prepare themselves to either recover losses from a business against the business or protect their business and personal assets from being exposed during a lawsuit. When the court decides that a business owner has used their business like a personal piggy bank and has performed any action that blurs the lines between business and personal, the court can actually pierce the protection normally granted by the corporation or the LLC. Let's meet the parties in the case. First, we have the DeWitt Truck Brokers Inc. company, who is a trucking company. They're a broker that arranged and paid for shipments of perishable produce as a service to Ray Flemming and his corporation. They paid carriers for freight charges, and they actually invoiced the company Ray Flemming for it, for which they didn't get reimbursed. So they're trying to collect the money that they are owed by Ray Flemming and his corporation. The defendant is, of course, W. Ray Flemming and his corporation. Ray Flemming owned about 90% of the W. Ray Flemming Fruit Company, which is a commission agent selling produce for the growers. Ray Flemming exercised complete control over all business operations. Flemming actually even at one point personally assured DeWitt that he'd cover the charges himself. So this is where he really blurred the lines between business and personal. If you're gonna have a corporate veil, right, use it. If you're gonna start going back and forth, then that's where you get caught. Now let's discuss when the veil can actually be pierced. Courts consider multiple factors before they decide if the corporate entity should be disregarded or not. One of them is undercapitalization, which means that you started a company or you're running a company with not enough assets to cover any debts that you may create with that company. So if you are going to go and take credit out, or you're going to go buy items, you better have money to pay that off. Number two, did the company ignore formalities? That's another consideration. So let's say every company is supposed to have meetings, make decisions, right? So formalities like minutes, corporate records must be maintained, those kinds of things. Did they ignore these formalities? Is this company an alter ego, or is it domination, for example? That's another factor. This is when the owner treats the business as a personal extension and not a separate entity. Remember, a corporation is like a separate person than the owner. Is the owner literally treating the company as themselves, right? Injustice or fraud is another factor. They must also ask themselves, would recognizing the corporate form sanction fraud or unfairness? So for all of us business owners or anyone going to influence how a business is ran, listen to this. What did Flemming did wrong that caused the court to say, yeah, you know what, let's make the owner responsible for all of these corporate actions? So the first thing was that they were grossly undercapitalized. So basically the corporation lacked sufficient funds to pay for any of its produce trading services or business. And another thing was that the corporate formalities were not followed. There were no records, no documents of meetings, and no real grievances or structure. They commingled funds. They use corporate funds for personal purposes and to repay himself on loans. Okay. Another thing was that Flemming was the sole beneficiary of the company. He would withdraw $15,000 or more every year while the corporation was unprofitable. Basically, the company kept going into debt. He would not pay people or companies, and he would still pay himself large amounts of money. And the last thing that they found on this company or on Flemming is that he continued to rack up debts, knowing full well that he wouldn't be able to pay them back. Now let's look at the ruling of this case. The court affirmed on the side of the plaintiff. The Fourth Circuit upheld the district court's decision to pierce the corporate veil in this case. W. Ray Flemming was held personally liable for the corporation's unpaid freight debts to DeWitt truck brokers. The combination of undercapitalization, ignored formalities for the corporation, commingled funds, and Flemming's total domination destroyed the corporate entity's separate legal existence. Basically, he treated this company like if it was himself, and the court decided, you know what, you're going to treat it like if it's you, it's going to be you. So let this be a lesson to make sure that they take precautions and put systems in place so that they do not make the same mistakes as a Ray Flemming Fruit Company, or Ray Flemming himself. Now let's talk about why this matters to you. According to Godnick and Durand in 2014, there's an article that says that California is the most willing to break the corporate veil. If you are a business owner currently, or you aspire to be a business owner, many piercing cases succeed because owners ignore formalities. Number one, they use business funds for personal expenses. That is the number one factor that courts flag. Number two, your home, savings, and personal assets are at risk if the veil is pierced. Protection requires ongoing discipline, not just filing papers. If you're a future advisor for business owners, your clients will rely on you to keep them protected. Number one, it's very important that you understand veil piercing factors, because this helps you advise your clients proactively. Number two, spotting red flags early, such as commingling or having no records, such as minutes, decision making, that sort of thing. This prevents liability exposure. This case is one of the most cited cases involving piercing the corporate veil, so it's very important that you know it well. Make sure that when you're advising companies, you have reviewed different cases, especially one like this, that gives you a heads up on what to look for so that you can better advise your clients. Now, here's a way to protect yourself. There's an action checklist. Number one, always have separate bank accounts. You never want to use your personal account for any business expenses, and you never want to use your business account for any of your personal expenses. Number two, maintain corporate records. Hold annual meetings and record minutes. Keep bylaws current. Number three, adequate capitalization. Always make sure that you fund your business adequately for its actual operations. Many companies will take out business loans just to make sure that they have the money ready. In my case, for my business, I prefer a business line of credit so that I have money waiting in case I need it, and I'm not being charged interest on whatever I don't pull. Number four, formal distributions only. What this means is that you pay yourself through a system that can be easily tracked. For example, pay yourself through payroll, okay? Do not pay yourself cash, or have some kind of documented distributions. Number five, document major decisions. Have board resolutions for contracts. Keep track of significant transactions. Number six, file required reports. Annual reports, statements of information, and franchise taxes, those have to all be filed on time.